Thank you. Hello, everybody. Very good evening. Today's session. We will continue with the non-resident taxation, the nuances and other aspects. The latter part of how to go about NRI taxation, other aspects. If you could recollect, going back to where we started. So as you can see, when we started off, this was the broad agenda in terms of what we'll be covering. And over the last two sessions, if you see, we had covered in terms of, the scope, the residential status, especially residential status for corporates, foreign companies, which are effectively managed from India, the poem, and then a very important Section 9, which is what we dwelt upon pretty deep, because that is a very, very significant provision for taxing non-residents, because it gives the extraterritorial power the income tax wants in order to tax the non-residents by virtue of invoking a deeming fiction. So today we will look at in fact, we also touched upon the withholding taxes, whereby the onus is passed on. Yes, it is taxable for non-residents, but then who is going to pay it with? Can we expect the non-resident to come, file tax returns, pay the taxes? This is keeping in mind that even residents themselves don't pay their fair share of taxes. We all know how many people in India pay taxes, the amount of population we have, the amount of income that is being earned. But nevertheless, leave residents for a moment. But even from a non-resident standpoint, very difficult to invoke the non-residents to ask them to file tax and pay advance tax or a self-assessment tax. So therefore, the onus is largely on the resident payers who makes these payments to these non-residents. The obligation is all on them to withhold. And we did look at it the last class as to what are the onerous consequences for a resident payer for not withholding taxes. So we will now, in today's look into the other aspects, which I would not discount them as not relevant, because when it comes to income tax or any fiscal law, as a matter of fact, there's nothing called as not relevant or relevant. But keeping in mind the wide scope and ambit that we have on India taxation, especially from an academic to final, very difficult, 298 sections with various subsections. Can't expect the examiner to keep questioning on every other aspect. So having said that, today we will be looking at the other aspects which are relevant for both from an academic standpoint as well as from a practical standpoint. The chapter 12A comes for NRI. We'll be going through those final parts of taxation of non-residents, and if time permits, that will give us an opening to double taxation relief, which will be the next session, which will be the next chapter or the main focus that we'll be going on. Having looked from a domestic tax law, we will move to the tax law. If I go ahead with today's session, let's do a very quick recap in terms of what we did in the last session, so that you all can get up to speed in terms of our discussions. So, as always, I would request the attendees to kindly put in your views, so that if there's anything, there's a misunderstanding or a misalignment, we will try to probably address it. This will also give you an idea as to how you have captured the provisions effectively. Now, having said that, my first the recap question, as you can see. So in the last session, we were largely focusing on royalty, FTS, which is the main source of income for non-residents, and then 97, as I alluded to, in terms of how to withhold taxes, and the taxability comes under 115A. So 115A, which comes as part of chapter 12, which is determination of tax in certain special cases. So we will continue other provisions that is there in 115A. So 115A as chapter 12 is basically to ensure that these special cases like a foreign company or a non-resident having a royalty or FTS, how do you tax them? Tax them at so and so percentage. Whether should they file tax returns or not. So you have a self-governing mechanism. So it is a self-contained code by itself, similar to how you have section 11, 12, and 13, which governs the public trust. So having said that, let's look at question number 1. Mr. X, who is a non-resident, shared its business process to Messrs. XYZ Limited for a sum of, say, INR 1 crore. So Mr. X claims that this is not a royalty under section 916, as the process shared has to be a secret process in order to be a royalty. Is the contention of the assessee valid? So the question here is, he says the royalty definition includes only secret process. So therefore, this should not amount to royalty. For sake of convenience, I'm to share the relevant. We discussed this as well. So royalty means consideration for transfer of all or any rights in respect of a patent, invention, model, design, secret formula or process, or trademark or similar. Starting of the work of or use invention, model, formula, process. So basically, royalty contains all property related is using. So secret formula process. So therefore, the contention of the tax payer is there has to be a royalty. There has to be a secret process. Only then it become a royalty. Otherwise, normal sharing of process will not amount to a royalty. Whether it is valid or not valid. I'll give a minute. 30 seconds for you to put A or B. Please do contribute. Please do participate. This will, no problem if you make mistake. Just give it a try. This is a simulated environment. How will you go about? Fundamentally, logically, if you're clueless, how you would approach this? Yes, it makes sense because if there is a royalty, somebody is parking something very useful or very secret. Otherwise, the idea being royalty is I give my intellectual property. That's what's called intellectual property. And somebody will exploit it to make money for which royalty is obtained. So it is logical to assume that, yes, it has to be a secret process. But having said that, we had a lot of interesting judgments. And finally, there was an amendment in Income Tax Act whereby the meaning of process has been amended. Section 9, clause 6, whereby, as you can see, process whether it will include and shall be deemed to always include a transmission by way of satellite, whether or not such process is secret. So the tax authority, the income tax legislation we did the satellite broadband services. So which are very secret to nullify to question number 1. Thank you. Sorry, had a small technical snag. Moving on to the next question. Question number 2. If you look, Mr. Dalve, a non-resident UK lawyer, appeared for an arbitration matter, commercial arbitration matter for an Indian client's commercial dispute. The arbitration happened over Zoom platform. Mr. Dalve contends that the fee is not taxable under Section 9, Clause 1, Subclause 7, which talks about fees for technical services as a team to accrue arise in India. So, Mr. Dalve, the non-resident UK lawyer, says, look, it's not taxable under Section 9, Clause 1, Subclause 7, as his services were only utilized in India by his Indian client, but it was not rendered in India. His contention was, I was sitting in London and doing it over Zoom. So there's nothing to do with India, and only the UK can tax it. Is the contention valid? Now, as if you recollect what we had discussed in the last session, when it comes to fees for technical services, the twin conditions, that is whether services should not only be utilized, should it also be rendered in India. This Supreme Court, in a very landmark judgment called Ishika Wajima Harima, held that twin conditions have to be satisfied. Now, this twin condition of Ishika Wajima has been nullified by virtue of an amendment to Section 9, Clause 2 explanation, whereby it is made very clear that there is no need for the services to be rendered in India. As long as the services are utilized in India, that is enough. Services utilized in India will be sufficient. Whether or not such services were rendered in India is immaterial. So therefore, to question number 2, answer will be invalid. His contention is not valid because rendering of services is immaterial to trigger Section 9. Move on to the next one. Because the idea of Indian government has always been, look, the idea of Section 9 is to bring a nexus to tax in India. So since a lot of these services were happening either in those days, even before technology days, many of these services were happening through courier and other aspects. They were not coming to India. So the idea itself was to ensure that a source is given. As long as the services are utilized in India, then India being a source country, India should get the taxing rate. That's why the purpose. But Supreme Court in Ishika Wajima gave a different dimension to it, which is now anyways nullified. As on date, we are not bothered where the services are rendered. As long as the services are utilized in India, then it will become taxable. So question number 3. Fees for technical services under Section 9, Clause 1, Subclause 7, payable by a resident to a non-resident will not be deemed to accrue or arise in India in which of the following cases? So a resident is making payment of FTS, fees for technical services, under 917 to a non-resident. It will not be deemed to accrue or arise in India in which of the following cases? That is, if the FTS is paid by the resident in respect of services that is utilized in business or profession carried on outside India, or for the purpose of earning income from any source outside India, or both situations mentioned in A and B. So if a resident is availing services from a non-resident, that is fees for technical services from a non-resident, it will not be deemed to accrue or arise in India if, in which of the following cases? If the services are utilized in a business or profession carried on outside India by the resident, or is it for the purpose of earning income from any source outside India for the resident, or both situations? The answer to this is both situations. So therefore, if the resident is making a payment to a non-resident, that is, non-resident is getting an income, the name of fees for technical services, and that services were utilized by the resident for a purpose of carrying business outside India or for purpose earning income from any source outside India, then they are excluded. So they come under the exceptions to section 917(7)(b) to be precise. So therefore, both situations, it will not be deemed to accrue or arise in India. We did look at a lot of examples in this regard. It's there in the problems as well. You can revisit it. So please watch out if a resident is making payment to a non-resident. You have to watch out for the exceptions. Similarly, if non-resident is making payment to another non-resident, when will it accrue or arise in India? If it is payable in respect of services utilized in India. It is payable. So this is a inclusion here. If it is for utilized in business or for purpose. So we did dwell a lot about this in the previous session. Now moving on to the next one. Question number 4 actually. Apologies for the numbering error. A foreign company had earned royalty in India amounting to INR 30 crores. These expenses incurred in earning this income is INR 10 crores. Now, F company insists that section 115A rate of 10% will trigger on the net income of 20 crores. That is 30 crores income minus your expenses. Taxability will determine only on the 10% on the balance net income of 20 crores. And hence 10% should come only on 20 crores, not on 30 crores. Is it valid? So now, as I mentioned to you, section 115A is a special provision, chapter 12, determination of tax in special cases, whereby 115A, the primary condition is you will be taxed on a gross basis. The tax will be done on the gross amount. So 30 crores is what it has received it. The tax will be done on the gross amount. And the other major condition is there shall be no deduction of expenses under section 28 to 43C, and then no chapter 6A deduction will be available. So this will be flat taxable at the rate of gross amount 10%. So therefore, the contention of the foreign company that it will have to be taxed only at 20 crores is wrong. All right. So one other aspect that we will on the same note touch upon is I have uploaded the problems as well, which you can download it. So I think this is again a very important provision. Question number 24. For assessment year 22-23, Mauritius Limited, a Mauritius company, lent a sum. So it was a lender. It lent a sum to its subsidiary ABC India. ABC India, while making the interest payment to Mauritius Limited, had deducted tax on the rates of 7.5% as prescribed under the India-Mauritius Tax Treaty. So, under the tax treaty, for these passive incomes, rates are specified. So, India-Mauritius Treaty has 7.5%. Under the Income Tax Act, section 115A, if you recollect, interest is taxable at 20%. Interest is taxable at 20%, but whereas treaty gives you a better rate of 7.5%. And this point I have mentioned throughout the two sessions as well. As per section 90 clause 2, 90 subsection 2, you can take tax treaty or act. A taxpayer can choose whichever is beneficial to him. So obviously he will choose a lower rate of 7.5%. Now the issue is starting from here. The issue is Mauritius Limited did not file its tax returns. So the question is, should this foreign company file income tax returns? Now Mauritius Limited did not file its tax returns, as according to Mauritius Limited, the taxes have been withheld in India. The taxes have been withheld in India. is the contention of Mauritius Limited valid? So they are saying, hey, I don't need to file tax returns because under the India Mauritius Treaty 7.5%, and the payer, that is the borrower, which is ABC India, has withheld the taxes at 7.5%, and therefore there is no requirement for me to file tax returns in India. Now, if you look at 115A, this is what I was referring to. Interest is taxable at 20%, but section 90, subsection 2, treaty rate, you can choose whichever is beneficial. Now, what is very important to notice, 115A stipulates certain conditions. We saw that the previous recap question, no deduction is allowed. Similarly, one of the important conditions is it shall not be necessary for the assessee to furnish a return of income if the following conditions are satisfied. So if the following conditions are satisfied, then the assessee need not file a return of income. What are the conditions? The total income consists of only interest or dividend income or royalty or fees for technical services. So it should be either interest, dividend, royalty, or FTS. In our case, yes, it is an interest, so therefore it is covered. But there are two conditions. Condition 1, it should be either interest income, dividend income, or royalty income or FTS. It is an interest income for us. And so therefore you have to satisfy both the conditions. And second condition says, tax deductible at source has been deducted from such income, and the rate of such deduction is not less than the rate specified in section 115A. That is what they are saying is TDS should be deducted and TDS should not be less than the rate specified in 115A. What is the rate specified in 115A for interest? It is 20%. Interest is at 20%. Coming back to in our case, interest is deducted at 7.5% under the India Mauritius Treaty. So therefore, the second condition to section 115A, that is if for filing return of income, is not satisfied because it says it should not be less than. In our case, it is less than the 20%. Therefore, return of income has to be filed. Return of income has to be filed because the rate of tax deduction should not be less than 20%. This is for interest. Okay. The given case, since the rate is only 7.5%, return of income has to be filed. Now you may wonder why, because the tax treaty gives 7.5%, and why this is this additional obligation for the foreign company to keep filing its tax return? Isn't it, unnecessary compliance for the foreign company? On a hindsight, yes, there is no doubt about it. But the problem, what happens is, why the government is very particular is because there is something called treaty shopping may happen. What do you mean by treaty shopping? A foreign multinational company may choose a benefit. They'll go, okay, India Mauritius has only 7.5% TDS. I mean, taxability on interest. So let's route the loan through a Mauritius company. They have nothing to do with Mauritius, but they will use this Mauritius company to take advantage of tax rates. So Mauritius, Ireland, and you have UAE. A lot of these are called the tax havens or low tax countries. So when I mean low tax, they don't charge much of taxes. So these tax dodgers use these tax havens to do treaty shopping. This is called shop, which is beneficial to you. So what the government is saying is, in such scenario, they want you to file so that they will assess. They will do an assessment. Once you file return of income, it is easy for them to do assessment. And they will try to find out, is the Mauritius Limited a real company, or is it just a brass plate letterbox company? So that is the reason why this specific clause is being introduced. If you are taking treaty benefit, or if the rate is less than the rate specified under section 115A, then you need to file your tax returns. So therefore, please watch out. An examiner might try to trust this. The key point to watch out is, if the TDS is less than the rate specified under section 115A, then in such scenario, return of income has to be filed. Now let's take a situation. If the Mauritius company has a tax rate of say 25%, obviously in this situation, a taxpayer will choose act or treaty, whichever is beneficial. So he will go for 20%. In that situation, you don't need to, the Mauritius company need not file its tax returns. So key point to watch out is, if it is less than the rate prescribed under section 115A, then return of income has to be filed. So this is one aspect that I wanted to touch upon in 115A. Trying to see if there are any questions. I hope my audio is clear now. In between, sorry, there was some issue in my internet connectivity. I've sorted it out. I hope it's clear. Okay, fine. All right. Thank you. So I will move on. Thank you for those who have participated. Now, one specific aspect, having looked at royalty, FTS, and section 115A, I just want to now segue into a very interesting aspect that you need to aware about royalty and FTS, and this will basically about the presumptive taxation. Now, to better understand, I think we will take this question number 25. Question number 25. XYZ GmbH, a German EPC company, rendered offshore technical services to BNT Limited, an Indian infrastructure company, for which it received a fee of 10,000 euros during assessment year 22-23. Discuss the tax implications. So a German engineering procurement construction company, EPC company, rendered offshore technical services. So what do you mean by offshore is, they had rendered these services from Germany to an Indian company called BNT Limited. So it received a fee of 10,000 euros. Now discuss the tax implications. Very easy. Section 917 will trigger. 917, fees for technical services. Because there is no need for the services to be rendered in India, utilization is enough. So section 115A will attract. and it will be taxable at 10% under the Income Tax Act under Section 115. So this is simple, straightforward, which we have well dealt adequately. Now, the major point which I wanted to drive here is the follow-up to it. The second situation, the above scenario, XYZ GmbH, that is the German company, has multiple clients in India. So what it has done is, it has set up a branch office in Chennai, which will cater to all the Indian clients. So they have set up a branch office in India. So sitting in India, they will cater to clients. Discuss the tax implication for XYZ GmbH. Now, a foreign company has a branch office in India. So remember the fundamentals. Business connection. We saw section 911. The business connection equivalent word normally used internationally is permanent establishment. That is doing business in India vis-a-vis doing business with India. So in this situation, by having a branch office in India, they are doing business in India. So therefore, the foreign branch, the branch office in Chennai, is a permanent establishment. We will also look deep into permanent establishment in the subsequent session, but permanent establishment is almost similar to business connection. The idea is you should be doing business in India. This is the fundamental underlying concept. So when you have a branch office, the term PE is defined in the Income Tax Act in the transfer pricing section 92, where it says any fixed place of business through which any fixed place through which a business is carried on. So the idea is that you have an office, you have some sort of a fixed place from which the business is carried on, then the foreign company is said to be having a permanent establishment in India. So therefore, they have a branch office in Chennai. All the more, this clearly establishes that they have a PE in India. So now, once you have a PE in India, the idea of gross basis of taxation won't work, because 917 fees for technical services is largely to cover only those situations where there is no business connection or a permanent establishment in India. If you have a business connection or a permanent establishment in India, the government wants you to pay taxes on a net basis mechanism. Because you have a business connection in India, you have an office in India, just like how any other Indian company has. So therefore, what they want you to do is drop your income statement, take whatever expenses pertaining to India, then pay taxes at 40%. Because as you know, foreign companies taxed at 40% in India on the business income. Now, this is very high rate. So there is one small benefit that the government has given. That is, they're saying, okay, I understand for all foreign companies to pay taxes in India, 40% is very high. So what we can do is, so what they have done is, under section 44DA, in order to ensure that these companies pay their fair share of taxes, because they have a permanent establishment in India, the government says you cannot take benefit under. That's why if you see specifically, they would have said section 917 will not be applicable if the income is referred to in section 44DA. So any royalty or fees for technical services in case of non-residents, 115A rate won't apply, because the section clearly says it is not applicable for income referred to in section 44 DA. Now let's look at what is 44 DA. So what 44 DA says is, if there is a permanent establishment in India for the foreign company, the royalty and FTS would be computed under the head profit gains of business or profession, chapter 4. And normal rates of tax would apply. What is the normal rate of tax? 40%. Now what they are saying is, you have to maintain books of accounts under section 44 because you are doing business in India. You have a branch office. So this branch office of the foreign company in Chennai is equivalent to any other Indian company. So you have to maintain books under 44AA. You need to have an audit report. You need to file your income taxes return and all those aspects. Now what they have also done is, they have also very clearly mentioned that there cannot be any deduction in respect of expenses not incurred in relation to P. That is, you cannot take all your foreign, because now normally 40% tax. So a foreign company would be very keen to try to push more expenses and to show lesser profit. So therefore, the government, in order to plug all these evasion strategy, they said, no, I will give you deduction if it is expenses incurred wholly pertaining to the branch office in Chennai. If it does not relate to it, then those deductions shall be not allowed, shall be disallowed. And similarly, there cannot be any deduction in respect of amounts paid to the head office. That is normally what will happen. They will say head office expenses for managing website, for managing this, that. So they'll charge heavy amount. So there is a specific prohibition for that. And they have also something called 44C, which says that you can claim up to 5% of the head office expenses. So therefore, in short, what I wanted to convey is, one should be very cognizant about 44 DA. Especially 44 DA will trigger if the foreign company which is availing the royalty or FTS has a permanent establishment in India. What is a permanent establishment in India? Permanent establishment in India is similar to a business connection. It is, P is very widely used in tax treaty. It is a tax treaty terminology. And globally, if a foreign company has a P in India, that means the foreign company has a presence, has a significant presence in that country. It is like a alter ego. So again, as I reiterate this, basically, if a P is there, then there is doing business in India. So when you are doing business in India, the idea is, the government says, you are using my infrastructure, the benefit. So therefore, you should pay taxes in India. So you have to, as depicted in this diagram, if there is an FTS paid by an Indian concern, if it is not effectively connected to a P in India, then simple, your 917 will attract. So you can just go to 917 and close it. 917. However, if the question like what we saw, if it is effectively connected to a PE, that is, if the foreign company has a branch office and the branch office in Chennai does all the fees for technical related services, then this is effectively connected to a PE. PE is defined as any fixed place of business, any fixed place through which a business is carried on. Any fixed place through which a business is carried on. So therefore, the foreign company's business is carried on in India through its branch office in Chennai. So there is a PE in India. In that case, section 44 DA will attract. 44 DA means net basis taxation at rate applicable to foreign companies. That is, rate applicable to foreign companies is 40%. At 40%. However, there are certain conditions. What are those conditions? You need to file your audit report. You need to file your tax returns. You cannot claim the expenses other than those that is incurred. So please keep in mind section 44 DA. So therefore, this specific question, you have to refer section 44 DA because the foreign FCO has a PE in India. So taxable at 40% on net basis, subject to other conditions such as filing your tax returns, maintaining books of accounts, etc. So this is very, very significant. Now, in the same note, let me move to question number 26. So, when there is royalty FTS, please look out for section 917 and also 44 DA. Now, question number 26. Please give a careful observation to question number 26. Mrs. ONGC India during financial year 21-22 has won a contract to explore and extract mineral oil from Krishna Basin. In this regard, ONGC India, for undertaking the oil mining activity, has engaged Messrs. Monsalto's Energy Services, an Italian company, for providing services with regards to seismic survey and services for prospecting for exploration and supply. So basically, seismic and prospect exploration supply, you can understand, oil drilling that happens in the offshore sea, the Krishna Basin. So where I can, drill, do the rig and get the oil. So they have engaged an Italian company who will do a seismic survey activity and also other related services for identifying and for exploration. It explores in the Krishna Basin as to where the oil can be. So once they find it, okay, oil is here, so then we can rig it. So this is how mining extractive happens in offshore, very, very broadly. So now ONGC would pay Monsalto, the Italian company, 10 crores for the project pertaining to financial year 21-22. 10 crores of service where Monsalto will bring its equipments, all those things, and they'll do a seismic survey services and also find out where can the exploration happen. So this is services provided. Now determine the taxability of Mrs. Monsalto. Now, first thing that should come into mind, we're talking about taxability of the Italian company. So this is the Italian, now you need to keep in mind that Italian company obviously is coming and doing it in India because it is in Krishna Basin, part of the Indian waters. So therefore, these services are happening in India. So that's why if you look at, you cannot blindly go to section 917. If you recollect section 917, when we did it, we specifically 917 excludes consideration for any construction, assembling, mining or like project. So now this will come under mining, oil mining, mineral oil mining. There is a board instruction, CBDT board instruction also clarifying that any services with regards to oil exploration will be as part of mining. Nothing but mining. What you're doing is you mine the underwater and to see if you can get oil from it. So therefore, the reason for excluding this construction, assembling, mining, or there has to be a physical presence. These are all things you cannot do remotely. Certain things cannot be done remotely. You have to be there present. So therefore, this is a question of doing business in India. It's not the question of doing business with India. This is a question of coming and doing business in India. So therefore, this will not come under 917. Now, what the government has done is, just like 44DA, they have given a specific section where you can come under presumptive basis. So there are certain provisions where the government has tried to make the life of the non-residents little easy, saying, okay, fine, you may be doing multiple, and India wanted to focus on infrastructure. So you may be doing multiple projects. And imagine extraction of mineral oils is a gold for India, because that's a revenue fetcher, revenue gainer, larger economic implications to it. So therefore, just like 44 ABAD, we do have a presumptive mechanism for non-residents, so that it is very easy for them to pay their taxes in India. Now, specifically, if you look at section 44BB, there are others like 44BBA, BBB. You can have a look at it. I'm not going to dwell on these things. It's there in the material as well. But I thought, let me touch 44BB because this has an overlap with royalty payments. Business of providing services or facilities in connection with equipment hire for using in prospecting and extraction of mineral oils, including petroleum and natural gas. So mineral oil will include petroleum and natural gas as well. 44BB has a definition. So we are here in 44BB, special provision for computing profits and gains in connection with the business of exploration of mineral oils. So 44BB is a non-obstante clause, which means it will override. It's a presumptive provision. So just like how others, presumptive you would have already seen in chapter 4, like your 44 ADA and other aspects. Section 28 to 41 deductions are not available. So what is the presumptive rate? The profits and gains shall be deemed to equal to 10% of the following amount. So they're saying you pay a 10% on your receipts, on your gross receipts. Now, one other unique feature of 44BB is, if you believe your margins are less than 10%, just like how you have in your other domestic presumptive income, if you maintain books of accounts and if you're able to claim a lower income than the presumptive rate of 10%, you can do that as well. So 44BB gives you a benefit to claim lower profits. Now, I want to add a caution here. This option to claim lower profits is not available for all presumptive incomes. For example, you see 44BBA, business of operation of aircraft in the case of a non-residents, say a foreign aircraft, they do not have an option to claim a lower profit. They have to give flat rate of 5%. This particular section 44BBA, does not provide any mechanism for claiming lower profits. So you should also be mindful about that. In fact, this particular summary of presumptive provisions applicable to non-residents will give you a good overall in terms of look here, nicely encapsulated. Lower profit may be claimed under section 44BB. 44BB is what we saw, extraction of mineral oil. So have a look at this. I just wanted to specifically highlight the fact that you need to be aware about there are presumptive incomes in terms of non-resident as well. So in the given case, section 44BB, section 44BB will trigger. And 44, so all these are specific to certain businesses. In this case, it is pertaining to, as you can see here, 44BB, business of providing services or facilities in connection with plant and machinery with or use in the prospecting for or extraction of production of mineral oils. So specifically mineral oils, 44BB will trigger. So you have a presumptive income of 10% and you have option to declare a lower profit. So therefore, so in this case, pertaining to mineral exploration, so section 44B will attract 10% on gross basis, or an option to declare lower income subject to maintenance of books of accounts and tax audit. So this is what I wanted to touch upon. As I mentioned, there are other presumptive income mechanism as well, 44BBA, BBB. So just have a look at it and then keep it in the back of your mind. It may be very relevant. And there may be a surprise question being sprung upon. 44BB and 44DA, in my view, are very relevant because 44, when it comes to 44DA, it can be royalty FTS towards any business. All you need is only a P in India. But 44BB, 44BBA, 44BBB are for specific businesses. So watch out for first the step would be to go for 115A, see whether it is royalty FTS. Then you see if there is a permanent establishment. If there is a permanent establishment, then 44DA will come, net basis, 40% taxation. And then if you still feel this pertains to certain specific business like extraction of mineral oils, then you go there. So specific will keep overriding. So if it is 44BB, then 44BB will override 44DA. This is also very clearly mentioned in the legislation. So this is how you would have to approach royalty FTS for non-resident on certain categories of income. Now, having looked at section 115A, which is coming as part of chapter 12 and determining tax in special cases. So one of the special cases 115A, wherein interest, royalty, FTS. Now, there are also other classes of income. So 115A is about interest, dividend, royalty. We have 115AB. So if you recollect under 115A, royalty FTS, the TDS obligations were coming under section 195 and 194 LB, etc., etc. Now let's look at other specific. Again, I may not spend on, I don't want to run through all those. There are very few, but some are relevant, some are very, very income specific, so not worth spending time, but you can always have a look at it in your study material. Nevertheless, I will go to the first one in the table in front of you, offshore funds. So any non-resident, these are all for non-residents. So any non-resident offshore funds, the taxable rate is at 10%. So what is an offshore fund, for whom it is applicable? You will have all these things. You can have a look at it. Probably help you out. If you look at 115AB, special provision for computing. So as I mentioned to you, chapter 12 talks about how to determine tax in certain special cases. So offshore fund, as the name says offshore, it has to be an overseas financial organization. And if it gets any units or long-term capital gains in foreign currency, for these specific overseas financial organization, there will be a taxable rate of 10%. So, and no deduction shall be allowed. Similar to 115A, there are no deductions allowed. No chapter 6A allowed. And then similarly, benefit of indexation will not be allowed. So specifically for certain overseas financial organizations, you have this benefit under 115AB. Now, similarly, you have 115AC. I just want you to be aware about it. The mechanism, as just how we saw in 115A, equally applies for 115AB, 115AC, 115AD. Maybe the rates alone will be different and the recipients. So for 115A, it is interest, dividend, royalty, FTS. 115AB, we saw it is for certain overseas financial organizations who will get certain income in India. 115AC is to promote, GDR, bonds for non-residents when an Indian company. So you can see these are sometimes economically, these are economic fiscal incentive measures. In order to attract foreigners to invest in bonds of an Indian company or a GDR, issued in accordance with a central government scheme by an Indian company. In such scenarios, in order to attract the foreign investors, unless there is a clarity and certainty in their taxation, nobody would want to dwell on it. So 115AC says, you come, your total income, if you get it from a GDR or bond, then your income tax will only be 10%. No other deductions is allowable, no indexation, etc., etc. So you don't need to file, even return of income is not required. And the relevant person who's making the payment will do the TDS obligation under 196C. Now, next one. This is very important. 115AD, income of foreign institutional investors. Now, as you can say, foreign institutional investors. Now, of course, there's nothing called foreign institutional investors. It is foreign portfolio investors. FIIs are subsumed under FPI, I think from 2013 or 14. But these basically, what are all the foreign investments that the India gets, either to FDI, that is foreign companies, non-resident investing in Indian companies. You have FPI. FPI includes foreign institutions or investors. They invest in bonds, shares, capital markets in India. So therefore, and you know how much is the capital market is being driven by these foreign institutional investors. So in order to encourage them, incentivize them, and give them clarity to ensure for their investment, if they invest in Indian capital market, it is going to play a major role in India's development. So therefore, 115AD specifically carves out a taxing mechanism for incomes that is earned by a foreign institutional investor. So 115 AD covers now what are the income that a foreign institutional investor gets and what is the rate of tax. So as you can see, there are bouquet of incomes that a foreign institutional investor will get. And what are those income and what is the rate of tax is specified here in the column number 3. For example, income received in respect of securities, normal securities is 20% in case of a foreign institutional investor. Interest referred under section 194 LD. 194 LD are certain specific bonds, rupee denominated bonds. So then, in order to promote Indian companies to come out with these masala bonds and to encourage foreign investors to buy these bonds, because this is a revenue raising mechanism for Indian companies, tax rate is only at a very concessional rate of 5%. The rest, if it is a short-term capital gains from transfer of securities, it will be 30%, just like other normal stuff. Income by way of short-term capital gain under section 111A, 15%. This is also the rate you have under 111A. And income by way of long-term capital gains, you are eligible to claim it at 10%. That is, this is for transfer of securities other than 1112. And for 1112A, you get 10%. 1112A, as you all know, I don't need to tell you guys about 112A and 11A. Equity shares, equity-oriented fund. 112A also says 10% without indexation. Now, here also income by way of long-term capital gains arising from transfer of securities. So it can be bonds, debentures, and if you're a foreign institutional investor, your LTCG will be taxable at 10%. If you have other income, it will be at normal rates of taxation. So effectively, what FII 115 AD does it, special provisions for computing tax on income. So this gives a clarity for foreign institutional investors onto how much they are taxed and for what they are taxed. So this is very important because the Indian market, even practically 115 AD is very relevant. Now let's to understand this better, let's look at question number 27. 27 is a global capital fund, which is a Dutch-based entity registered as a FPI in India. Now don't get confused. As I already mentioned to you, a foreign institutional investor, the term doesn't exist anymore. It's called foreign portfolio investor. FII gets subsumed under foreign portfolio investor because if you are a fund and you want to invest in Indian market, you have to get registered with the SEBI. So therefore, you have to get yourself registered as FPI. Again, I'm not getting into nuances. I think it will be part of your other subjects. So an FPI will not hold more than 10% equity shares in a listed company, etc., etc. So the question says it is registered as a FPI, so which means it's a foreign institutional investor. And through its investments in India, the Global Capital Fund in financial year 21-22 receives the following income. Interest income, 50 lakhs. Dividend income, 50 lakhs. Now, out of the interest income of 50 lakhs, 25 lakhs pertains to interest received from investment in a rupee denominated bond of an Indian company. So on this 25 lakhs pertains to interest received from an investment in a rupee denominated bond of an Indian company. This is called the famous masala bonds. Now determine the tax liability for Global Capital Fund. Further, with regards to the dividend withholding, the fund wants to ascertain whether the tax treaty rate can be availed. Now it wants to know, can the tax withheld, can it be at whoever withholds? Normally the Indian company which makes the dividend payment will have to withhold. The question is, should it have to withhold at the rate specified under 115 AD, or can I take 3T rate is the question. But we'll come to that second part. First, let's try to understand what is the income taxability. Now, if you go to 115 AD, it has, the question says it has two incomes. One, interest income, another is the dividend income. Now, income received in respect of securities. So therefore, this is nothing but your dividend income, because this is in respect of securities. So it will be 20%. So dividend income will come at 20%. Interest income will also, because these are all income received in respect of securities. Interest on NCDs, it can be anything. So this will come under 20%. So income received in respect of securities will be 20% in case of FII. Now, only aspect to watch out is interest deferred under section 194 LD, the rate of tax is at 5%. 194 LD is basically your rupee denominated bonds. So concessional tax rate of 5%. That is, if it is issued up to certain date, 194 LD, which you may have a look at it in your Income Tax Act as well. So 194 LD, as I already mentioned, these are rupee denominated bonds given primarily to encourage Indian companies to give masala bonds. So any interest on these rupee denominated bonds, so you can, a foreign institution investor can subscribe to these rupee denominated bond of an Indian company. For that, there is a concessional rate available at 5%. So therefore, coming back to this question, the taxability will be under section 115 AD, special rates, special tax on special cases. So FII will come under 115 AD. Interest income, income from securities, that is interest and dividend, is taxable at 20%. However, interest under section 194 LD, that is rupee denominated bonds, will be taxable at 5%. Therefore, taxable income will be as follows. Interest income 25 lakhs plus your dividend 50 lakhs. So 75 lakhs at 20%, and interest income rupee denominated bonds 25 lakhs at 5%. This is, of course, excluding surcharge and cess. So this is the taxable mechanism under 115 AD for foreign institutional investors. So they get a special rate of taxation on income. So you need to be careful about these small nuances. Now, obviously, when the Indian company makes this interest, they have also been directed to withhold the tax under 5% under 194 LD. And if you also look here, 196D talks about income, withholding of taxes by the Indian company who are all giving interest or dividends. They have to withhold taxes under section 196D at 20%. Now, just to complete this, whether tax treaty rate can be availed. Let's assume tax treaty rate is at 5% or 10%. It's a dividend, it is at 10%. Can treaty rate be allowed? Interestingly, 195, if you in the last class, if you look at the question also in rates in force, 195 is included, 195 covers rates in force. Rates in force includes section 90. So therefore, treaty rates can be used for withholding tax under section 195. The question now comes is, 196 was not specifically included in the rates in force under 237A. So therefore, there were a lot of recommendations saying, look, our questions also in the minds of the detectors, Indian detectors, as to should I give effect to treaty. Now, that has been clarified with effect from assessment year 21-22, whereby tax can be withheld at the treaty rate as well. That is, whichever is beneficial. So, if the treaty rate is at 10%, so Indian company wants to give dividends to a foreign institutional investors, 196D says it is 20%. 196D also says now assessment year, the effect from assessment year 2020 and 22, that you can take section 90 rates as well. So therefore, if the dividend rate under the treaty for that foreign institutional investor, let's assume in our case, he's I think is a Dutch, it's a Dutch-based entity. So under the India-Netherlands Dutch tax treaty, if the rate is at say 5%, then the Indian company can withhold tax only at 5% and need not withhold tax at 20%. Withholding at 5% is sufficient. So therefore, tax treaty can be availed, because until this amendment, the position was tax treaty rate cannot be used for withholding taxes, because it is not coming as part of 195, it is coming as part of deduction under section 196D. So therefore, treaty rates cannot be invoked. Now that has been specifically amended in the request of foreign institutional investors. So now any dividend income made to a non-resident foreign institutional investor for which tax needs to be deducted under section 196D, withholding tax under treaty rates can also be chosen if it is beneficial. That is, if it is lesser than 20%, treaty rates can be invoked. There is also, I would also recommend you to please look at the last problem. Very straightforward, simple question on taxation of FII. So question number 10, have a look at it, do this as an assignment, refer your 115 AD rates, interest received on investment in rupee denominated bonds. We just had a look at it. It is taxable at 5%. Dividend from listed shares of Indian companies under 115 AD, it is 20%. There is interest on securities, 17,32,000. And there are income from sale of securities and shares. There are some capital gains income as well. Income from sale of securities and shares. So 111A. It's a very straightforward, simple calculation. You need to find out the interest and other aspects. So look at 115AD. So this normally, these are the kind of questions that will be tested. So don't get intimidated or overall seeing FII and other. Just keep in mind that special rates are mentioned in section 115AD, and then based on which you need to apply. So please have a look at question number 10 in the material as your assignment. And 115AD, as I mentioned, gives the different rates for different kinds of incomes. Now, with this, I'll move to the last determination of tax in special cases. Again, it has become very relevant is 115 BBA, non-resident sportsmen or sports associations, non-resident sportsmen or sports association. What I would do is let's go back to the problems note. So you understand with the situation, the question, then you'll be able to appreciate it better. Let's first look at question number 28. Mr. Ian Bishop, resident of Trinidad and Tobago, contributes to an Indian newspaper his views and insights on the ongoing India-West Indies one-day series. For this, the Indian newspaper will be paying him a consolidated sum of 5 lakhs for his contribution as an article to the paper. Determine whether the said sum is taxable to Ian Bishop for financial year 21-22. And also, what are the obligations, if any? So 115 BBA was largely introduced because many sports events, I'm not going into digital sports, that's e-gaming is a new avatar, it's a new controversy altogether. I'll not get into esports because there are a lot of questions going on as to whether esports, e-gaming is a sports at all at the first instance. Because sports, as you know, is conventionally one to do with physical attributes, not sitting in chair and playing with your headphones. But anyways, there are some countries notified. I'll not get into esports now. But generally, when it comes to sports, it's a performance based. And it's always, you have to be physically present. And there is a nexus. So now a lot of these non-resident sportsmen and associations as well, with a lot of events happening like the World Cup in cricket, and now over the last decade or so, proliferation of the sporting leagues like Indian Premier League, football, ISL, Kabaddi, etc., etc. You have a lot of non-resident people coming in participating. And these are performance happening in India. So India deserves a quantum of income for that quantum of taxes because you're using India, you're coming to India and playing IPL in India. So therefore, there is a nexus in India would like to tax. So therefore, 115 BBA was introduced. So under 115 BBA, a sportsman who receives income by way of participation in a game, this is other than your 115 BB that is winning some prosper. So a sportsman who gets income from participation in India in any game, and income received in advertisement or contribution of articles relating to any game or sport in India in newspapers, magazines, or journals. Not only on that note, I also say there are other two as scope also that is covered. If you're a non-resident sports association, they are also, and if there's any amount they're getting it, that will also come under 115 BBA. This was introduced in light of the fact that when India hosts World Cup, along with other Asian countries, for example, cricket, when we did in 1996 and also in 2011, another aspect. So there are some amount that India will guarantee to other associations as well. So those associations will, because India gets the main hosting rights, those associations which gets money from India, they will have to pay taxes. And not only sportsmen and non-resident, you also have entertainers who is not a citizen of India and is a non-resident. For any income received or receivable from his performance in India. So any entertainer who comes for his performance in India, say Justin Bieber comes to India for a concert and does a music program for which he gets money, that income will be taxed under 115 DA gross basis at 20%. At 20%. No deduction is allowed, just similar to other 115 DA. There are no deductions that can be claimed. And the best part is the person who is going to make the payment will have to withhold the taxes, similarly to other under 194E. Under 194E, you need to withhold taxes. And no requirement to file the return. That is, if the 194E tax deduction has happened, then there is no need to file your return of income. So therefore, coming back to this question, so 115 BBA section 115 BBA specifically covers sports person getting income from contribution in the form of articles, form of writing an article. In a newspaper, or journal, or magazine. The said income is taxed at 20%. The Indian newspaper entity has to withhold taxes under section 194 E at 20%. No need to file return of income by Mr. Bishop if the taxes are withheld appropriately. So this is in nutshell section 115BA applicable for sportsmen, entertainers, and sports associations as well. This is getting very prevalent in light of the fact that we are getting and sports and entertainment are becoming a mainstream industry by itself. It's no more a leisure, supposed to be a hobby. Today, sports and entertainment is an industry by itself, significant economy behind it. One last aspect on 115 BBA, very interesting, that you need to be extremely aware about. Possibly an examiner can outsmart or outwit you. Let's take this question number 29. Mr. Unmukh Chand is a sports person. He's an Indian citizen, but is settled down, or has settled down in the US. So he comes to participate in sporting games in India, for which he receives compensation. Please examine whether Mr. UC is liable to tax in India under section 115 BBA of the Income Tax Act. So this is a normal question that we normally encounter. When I mean we, as a resident payer, so let's assume you are going to pay your part, you're running a sporting game, you're calling Mr. Unmukh Chand, and then you want to know whether on the payment you need to withhold tax under 194E. Now, why I specifically mentioned this question is, you can look at here. Maybe I'll show you the study material for you to better understand the material. The assessee should be a sportsman. Yes, Unmukh Chand is a sportsman who is not a citizen of India and is a non-resident. So this is applicable only for those sportsmen who should not be a citizen of India and he should be a non-resident. In our case, Unmukh Chand is a non-resident, but he is a citizen of India. So please watch out, because we get a lot of these Indian citizens who have moved. Say, even for example, as a matter of fact, Vishwanathan Anand, who is a citizen of India, but he's largely settled down in Spain or in Europe for obvious reasons, or for reasons it's conducive for his chess playing. So in such a scenario, can 115 BBA merely because Vishwanathan Anand is a non-resident? Can 115 BBA? No. 115 BBA is applicable only to those sportsmen who is not a citizen of India, and this is a very unique, because citizenship is being brought into here, who is not a citizen of India and is a non-resident. So therefore, in the given case of Unmukh Chand, 115 BBA won't trigger, or rather won't, since he is a citizen of India. 115 BBA is not applicable to Mr. Unmukh Chand's income. So in that case, sometimes it may also augur well, because in that case it may become a professional services. So section 195 may come, and you may have to only withhold taxes under only at 10% under section 195. It becomes a fees for professional or technical services, because professional services may also include, this is again a question mark, whether sports is a profession, but assuming it is, taking a very conservative view, one can say 917 will attract, or one can even say it is not taxable, is another income. Anyway, the point what I wanted to drive is 115 BBA is not applicable, because in order to attract 115 BBA, he should be a non-resident and should not be a citizen of India. And again, as I mentioned to you, if TDS is deducted. Now, one question that will crop up is, should I give treaty benefits? Should I have to look at whether treaty? Now, interestingly, in treaty, the tax treaty, there is a certain specific provision called Article 17, taxation of entertainers and sportsperson. There, it will tell who will get the taxing rights. So the question was, should I have to invoke tax treaty and then see whether who has the taxing rights, and then tax needs to be deducted? Now, interestingly, this is coming under section 194E TDS. Please note 194E. And 194E is not included in rates in force 237A. I recollect again, the rates in force definition includes 195. So if it's in 195 and section 90, so which means any treaty rates will come under 2 clause 37 on the rates in force, 2 clause 37A. But when it comes to 194E, is not included in 2 clause 37A. So therefore, the Supreme Court in Pilcom recent judgment held that there is no question in seeing treaty. Treaty will come only in the case of it's a 195 withholding taxes. So if you are withholding taxes under 194E, there is no requirement to look at tax treaty, because 194E clearly mentions the rate as flat 20% withholding karna padega. There is no point of saying, and if you go to 195, that's not the case. It will say taxes have to be deducted at rates in force. Now, what is rates in force? Go to section 2, clause 37A, where 195 is mentioned in 237A, and 195 also includes section 90 rates. Section 90 is your tax treaty. 90 gives the legal mechanism for tax treaty. So only for 195, there is tax treaty. Similarly, the foreign institutional investors were amended. 196D was amended to include specifically section 90 here. So the same controversy came in because 196D also has a flat 20 age. It doesn't have rates in force. So there was a doubt as to whether should one look at treaty for rates. That has been now clarified, specifically included in the 196D. Either go for 20% or section 90, whichever is beneficial. But there is no such mechanism under 194E. It is flat 20%. So therefore, if somebody asks, can I look at treaty? In my view, no, very difficult. For withholding tax, 194E is not included as part of 237A rate in force. So you cannot give treaty benefit at the time of deduction of taxes. So just to quickly summarize 115BB again, it is actually, sorry, this is 20%, not 10%. The rate is 20%. Sportsman, entertainment or sports association, and the payer to these non-resident sportsmen who should also not be a citizen of India, tax has to be withheld under section 194E flat at 20%. No treaty benefit is allowed. 115 AD, income of foreign institutional investors. There are different rates specified for different classes of income, for interest income, short-term capital gains, etc. TDS has to be withheld at 190 and at those rates specified under 115 AD as per 196D. However, 196D gives the comfort that you can also take the tax treaty rates if it is beneficial to you for withholding of taxes. So that's it to do with chapter 12, determination of tax in special cases. So what we will do now is we will move on to treatment for non-resident Indians, but we will do that after a short break, 7:32 now. So we will take a 10-minute break and then reassemble at 7:45. So let's meet at 7:45 and then we'll continue with chapter 12A. So let's take a 10 minutes break. Welcome back. So we were looking at largely the taxation in special cases. But before I move on to a very important the NRA taxation, to better appreciate 115 BBA, please also have a look at illustration 11 and illustration 12 in the material, which strengthens the concept further. If you look at section illustration 11, the financial year 21-22, Nadal, a tennis professional and a Spanish citizen, participated in a tennis tournament and won prize money of 15 lakhs. He also contributed articles for which he was paid 1 lakh. He also got a file by a soft drink company for appearance in a TV advertisement. Although his expenses in India were met by the sponsors, he had to incur 3 lakhs towards his travel cost to India. He was a non-resident for tax purpose. So first thing for 115 BBAs, he should be a sports person. Yes, Nadal is a tennis professional. He should be a non-resident for tax. Yes, he is, and should not be a citizen of India, being a Spanish citizen. So he satisfies 115 BBA. Under 115 BBA, all these three are captured. That is performance income, income from participating in a sport event, articles in a tournament, and advertisement. So overall put together is 15 lakhs of participation money, 5 lakhs soft drink advertisement, and 1 lakh in a local newspaper articles. Works out to 21 lakhs. And this 21 lakhs will be chargeable to tax under 115 BB at 20% flat. The 3 lakhs that he incurs towards travel cost to India, again, just like other 115A, any other sections, they are taxed at gross basis. So no deductions is allowed. Deductions are allowed only if it's on a net basis mechanism. So it is flat tax at 20% plus an education cess. Now he need not file his return of income because the question is, does he need to file? He need not file if provided his income is only from 115 BBA and tax has been deducted under section 194E to that effect. If both has been done, then there is no need for him to file his return of income. Now, before I get on to the next part, which is having looked at presumptive income, having looked at chapter 12, which is income determinant. Now, chapter 12A is the final main important aspect that we need to be cognizant and aware about for determination of taxation for non-residents. And then after that, we look at what are the incomes exempt for non-residents, which will completely cover the entire piece of the puzzle. Now, on chapter 12A, this is a specific treatment available for non-resident individuals, non-resident Indians precisely. All we have saw is, this is again, just like chapter 12, determinants of tax in special cases. Chapter 12A is specifically for non-resident Indians. So as you may know, this is to, promote NRIs bringing back money into India. Now, before I go into that, I did see a few questions which I will quickly touch upon. There was a question as to Naveen, ATC cannot be claimed for life insurance made outside India, because the idea of giving ATC itself is to promote Indian investment products, and if you're going to stay back in India and retire in India, so that tomorrow the social security and savings get benefited, so that India today is a young country. But tomorrow, if it at some point in time when we have a lot of old people coming in, social security is very important. So therefore, ATC idea is to promote Indian products and not foreign made. So that's not possible. Now to Vidula's question, how will filing of return curb treaty shopping practice? See, Vidula, how it will curb is when you file tax returns, when they mandate you to file tax return. The tax return will contain a lot of details, and it gives power for the tax authority to open up an assessment and find out, are you the real owner? What I mean by it is, you recollect the Mauritius example, Mauritian company giving a loan to Indian company and availing a concessional rate of 7.5 under the India Mauritius. Now, if you normally see, the Mauritius company will only be an intermediary holding company. So above Mauritius, you will have a US company. So they would have done treaty shopping and they would have thought, okay, US India is very expensive. If we directly give the loan to India, the tax rates are pretty high under the India US treaty. Let's go to Mauritius. US Mauritius treaty may be beneficial. And then similarly, India Mauritius is beneficial. So essentially giving mechanism for avoidance of taxation. So now, at least under the filing treaty returns, the tax authorities can at least find out, is really the Mauritius the owner. So we have something called the beneficial ownership, which you would have seen in your Companies Act as well. But as such, the income tax doesn't have a concept of beneficial ownership defined anywhere. So who is the beneficial owner? So ultimately, if the money is only Mauritius gets it and immediately going to pass it on to US, then the beneficial owner is US, and only the India-US treaty should be applicable. So these kind of mechanisms will help the government to at least find out, rather than if there's no return filing, very difficult. Of course, today now we have exchange of information and various other aspects, but at least there is some element in getting more direct information and easy, instead of going through diplomatic route or through other treaty channels. This gives the upper hand. So may not fully curb, but definitely will act as a deterrent and will give some fillip to the tax administration. Naveen, TDS provision 195 in case of capital gains arising from transfer of listed shares. Now, if you see under 195, any sum that is payable. So if you recollect our discussion, 195 is an omnibus, so any sum. So a non-resident selling a listed shares, then the buyer looking at 195. So if you look. So if you look at 195, any sums payable by any person to a non-resident which is chargeable to tax in India, credited income tax at rates in force. So therefore, through that mechanism, if there is a capital gain sale happening, this is also applicable for immovable properties as well. A non-resident selling an immovable property to a resident, then the resident has to withhold tax under section 195. So if it is the stock exchange who are there, then they will have to facilitate the provider will facilitate the TDS mechanism. So the 195 gives an whole ambit for withholding of taxes. Good, Namita, very good point. Beneficial owner defined under section 139(1), yes, that will also help. But there, the 139(1) beneficial owner is largely with regards to filing written off incomes, but one can take recourse to that as well. But here, the beneficial ownership I'm referring to is in larger picture under the international tax law, because what has happened is there are foreign courts which have held that beneficial owner means a person who has a complete control and not the who should be the real owner and not just an Amkevasi owner. But yes, 139(1) definition may also be helpful, but 139(1) beneficial owner was largely introduced in the context of filing. One can take recourse to it, but unless the tax treaty has a clear definition of what a beneficial owner is, it will be very difficult to invoke the beneficial owner definition under the Income Tax Act. So there are a lot of talks going on globally. Should we have an harmonized definition of beneficial ownership? We'll have to wait and watch. So the beneficial owner will tell me if the beneficial owner is the US, then only India-US tax treaty should be taken and Mauritius tax treaty should not be looked into. But Now, yeah, anyways, I'm not going to go deep into it. But yeah, these are some of the challenges you have. So that's why filing written off income is prescribed. Now, I will move on to chapter 12A. Again, as the name says, this chapter 12A is largely for tax treatment of non-resident Indians. So the idea is this says special provisions relating to certain incomes of non-residents. The non-residents here are largely defined as non-resident Indians. So this is for the Indian diaspora community. The idea is those Indians who have gone abroad, they still have the connection, passion, nexus, whatever you want to call with India. So therefore, the idea is that's an easy money to tap for foreign investments. And India being a developing country, we need foreign investment. So if the NRI diaspora community would be a good community to easily get the money. So therefore, there are incentive mechanisms that was introduced way back. This was introduced in 1983 in terms of giving beneficial and some concessional. Now, of course, it is not largely concessional anymore, but at least the idea was to bring some sort of a regime exclusively for non-resident Indians. So as you can see, the chapter 12A provisions starts from 115C, C, D, E, F, G, H, and I. So it is basically to NRI who invest in certain foreign exchange assets and who derives investment income and long-term incomes. So let's run through. So the idea is NRI getting certain specific income. Only those incomes are eligible. So let's look at the scope for 115C. So chapter 12 has special provisions for taxing non-resident. Now, as I mentioned to you, 115 is special for whom? It is for non-resident Indian. So an individual, as you can see, the provisions of this chapter are applicable to a non-resident Indian who derives investment income from a foreign exchange asset and long-term capital gains regarding. So who basically derives investment income and long-term capital gains income from a foreign exchange asset. Now, first, let's look at one by one. Who is a non-resident Indian? A non-resident Indian NRI is basically who is a citizen of India and person of Indian origin, who should not be a resident, basically. So, who should be a non-resident? He can be a person of Indian origin. When you are a person of Indian origin, doesn't matter whether you are a citizen of India or not. You should be either a citizen of India or a person of Indian origin who is not a resident. You all know who a person of Indian origin is. I'm not going to get into it. So this chapter is exclusively for the NRIs. Now, derives investment income and long-term capital gains from a foreign exchange asset. So what is a foreign exchange asset? Foreign exchange asset is any specified asset which the assessee has acquired or purchased within convertible foreign exchange. So basically, in terms of dollars, any convertible foreign exchange, rupee is not a convertible foreign exchange. So therefore, if any specified asset is purchased or acquired or subscribed in convertible foreign exchange, then they become a foreign exchange asset. Now, what is a specified asset? This is very important. Please pay attention to it. A specified asset will be shares in an Indian company. So therefore, an NRI investing in shares in an Indian company through convertible foreign exchange. So it's not about specified asset. It should also be acquired or purchased in convertible foreign exchange. So shares in an Indian company, debentures issued by an Indian company, which is not a private company. So which means only public companies debentures. deposits in an Indian company, which is not a private company, so which means private company deposits are not specified assets. Any security of the central government. So security is as per section 2 clause H of the SCRA, which can be bonds, debentures, shares, etc. Any other asset which the central government notifies. Anyway, so you need to watch out for these four. Shares in an Indian company, debentures issued by an Indian company which is not a private company, deposit in an Indian company which is not a private company, and any security of the central government. So if this four buckets of specified assets, the NRI acquires or purchases in a convertible foreign exchange, this will come under the scope. Now, if I make any investment income from this, that is any income that I derive, can be interest, dividends, any income that I derived from this foreign exchange asset, or any long-term capital gains. So any long-term capital gains is, you all know long-term capital gains which I get by selling these specified assets, transferring or selling these foreign exchange assets, then those incomes will be taxed in special mechanism specified under 115 C, D, E, and F. So we saw 115 scope. 115D says it will be done on a gross basis. So similar to your 115A on gross basis. And 115E talks about rate. So rate is, it will be 10% if it is a long-term capital gain. If it is an investment income, that is interest or dividends, it can be anything, it will be 20%, the rate will be. So it will be 10% for long-term capital gains and 20% for investment income. Now, what is another very interesting aspect to look out is, for long-term capital gains, there is exemption available. So, if a non-resident Indian sells any of these specified asset, shares in Indian company, debentures issued by an Indian company, deposits in Indian company, he sells, and within 6 months, he reinvests them in any of these specified assets again, then they are exempt from taxation. This is very similar to what you would have seen in your 54 exemption. But this is a very unique exemption available for NRIs specifically. And I believe as practitioners or as advisors, these are some of the aspects that we can advise NRIs, especially now with a lot of NRIs, and who are very keen to invest in India in startups, in capital markets, etc. So one needs to be extremely vigilant, or rather, as a prudent, these advices can be made. So you get any income made by NRI on certain specified assets acquired in a convertible foreign exchange mode. Income from investments will be taxed at 20%. Long-term capital gains from the transfer of those specified assets will be taxed at 10%. And if it is a long-term capital gain, you also get exemption. That is, where a non-resident has transferred a long-term foreign exchange asset within a period of 6 months from the date of such transfer, invest the whole or part of the net consideration. Please watch out, it should be the net consideration. This is similar to your 54F. Whole or part of the net consideration in those specified assets. Then entire capital gains or your proportionate. Very similar to, principles are similar to your 54F. And what do you mean by net consideration? You can take net consideration means the value of consideration from transfer less expenditure incurred in connection with transfer. That can be deducted. Now, with this basics, I think we will try to look at few situations to better understand Chapter 12A. Go back to the problem sheet. Let's look at question number 30. Mr. Rajan is a US citizen and a person of Indian origin. During financial year 2016-17, he had subscribed for non-convertible debentures amounting to INR 30 lakhs of NM Private Limited in convertible foreign exchange. During the financial year 21-22, current financial year, he redeemed the debentures of the private limited company, NM Private Limited, for 50 lakhs. On September 2021, he utilized this money to invest in shares of ABC Private Limited. Mr. Rajan wishes to ascertain if he can claim exemption under Section 115F. So let's go one by one step. So to repeat the question, so Rajan is a US citizen and POI, and he had subscribed for non-convertible debentures amounting to 30 lakhs of NM Private Limited in convertible foreign exchange. And during the financial year 21-22, he redeemed the same for 50 lakhs. And on 21 September, that is within 6 months from the date of transfer, he utilized this money to invest in shares of ABC Private Limited. So Rajan wishes to ascertain if he can claim exemption under Section 115F. Now, before he can know whether he can claim exemption or not, first we need to, let's go step by step. Yes, he is a US citizen and POI. So Chapter 12A is applicable for NRI. He is a NRI because he's a person of Indian origin. Now next, the scope should be, it should be a specified asset that should be acquired in convertible foreign exchange. So he has got it in convertible foreign exchange. The question is, whether is this a specified asset? What is the asset he has got? He has got a non-convertible debentures, so basically your debentures, NCDs, of NM Private Limited. So now let's look and see, go to specified asset under the definition of 115C to see whether NCDs are included. So we are in 115C, specified asset, any of the following assets. Shares in Indian company, no. We are talking about non-convertible debentures in a private limited. Debentures issued by an Indian company which is not a private company. So this is the main part here. Debentures issued by an Indian company which should not be a private company. So in the given case, the specified asset should be a debenture of a public company. Since the investment is made in debentures of a private company, this is not a specified asset. Hence, Chapter 12A is not applicable for Mr. Rajan. Now, what if instead of NM Private Limited, it is NM Public Company, which say a listed entity, listed company, share NCDs? Then it is a specified asset. So this is a specified asset. Therefore, Chapter 12A will be applicable because this convertible foreign exchange specified asset. And entire net consideration should be reinvested What does 115F says? Entire net consideration should be reinvested in a specified asset. Now, reinvestment is in shares of an Indian company, shares of a private limited entity, ABC Private Limited. So, question is, we'll just look here. If you go to 115F exemption, within 6 months it has to happen. Yes, that is the case because June he has sold and September is invested. The investment should also happen in a specified asset. This is very important. Now again, go back to specified asset. Shares in an Indian company. So therefore, since this is shares in an Indian company is defined in section 2, clause 26, which will include any private company, any company incorporated in India. So therefore, in my view, this is a specified asset. Therefore, exemption can be availed under section 115F. Important point to note, this investment, reinvestment should be held for at least 3 years by the assessee. So he cannot immediately sell. So this shares of the Indian company, which he has reinvested, should be held for at least a period of 3 years from the date of its acquisition. Look here, where the new asset is transferred or converted into a money within a period of 3 years from the date of its acquisition, the amount of capital gains arising shall not be charged to tax. So condition is within 6 months I have to reinvest, and that new asset should not be transferred or converted into money for at least 3 years. So the first part is not a specified asset, so hence miss out. In the second part, where we change the question to a public company, in that case, 115F exemption is allowed. We'll move on to another variant. Mr. A. Subramanian is a US citizen and a person of Indian origin. During the financial year 18-19, he had subscribed to listed NCDs in convertible foreign exchange. During financial year 21-22, by virtue of regular stay in India, he had become a tax resident, meaning a resident and an ordinary resident. He had received interest on the NCDs amounting to INR 10 lakh. In this regard, he wishes to ascertain whether he will be eligible to claim concessional tax rate of 20% on the investment income stipulated under section 115E. So I'll repeat the question again. Subramaniam is a US citizen and a POI. During financial year 2018-19, he had subscribed to listed NCDs in convertible foreign exchange. At that time, let's assume that he was a non-resident. During financial year 21-22, he was in India. Maybe due to COVID, he would have come and he would have stayed back. From a tax standpoint, he becomes a resident and ordinary resident for financial year 21-22. Now the question is, there is an interest amount which he has got from the NCDs that he holds, amounting to INR 10 lakhs. He wants to know whether he is eligible to get a concessional rate. That is, investment income, if you recollect, is taxed at 20%. Investment income, 20%. And this is an investment income. In fact, what is an investment income? You can see any income derived from a foreign exchange. So this is an interest from the NCD. So therefore, this is a investment income. The question is, he is a resident now. Will it be applicable? Because the section is applicable only for a non-resident Indian who derives investment income. So he is a non-resident Indian. There is no doubt about it, because he is a individual being a citizen of India or a person of Indian origin who is not a resident. So this is where the problem. The person of Indian origin who is not a resident. So he fails to satisfy the NRA definition. Now, what the income tax department has done is, the income tax legislation has done is, they have given a slight concession or kind of a flexibility. The flexibility is coming under section 115H. Because as you all know, tax residential status is determined year to year and not fixed. There could be a possibility that an NRI may become a resident in any of the years. So what 115H gives the benefit is, where a person who is NRI in any previous year becomes assessable as a resident in any subsequent year, then he may furnish a declaration in writing along with the return of income under section 139 for the year in which he is so assessable. The declaration shall be to the effect that this chapter shall continue to apply to him in respect of investment of income derived from foreign exchange assets, being debentures, deposits, securities of central government, and such other notified assets. So 115H gives you a benefit to continue to get the investment income with regards to debentures, deposits, securities. So please note here, small nuance, shares of an Indian, any income from shares is not there. So that's why in my question, I would have given it as a non-convertible debentures. So 115H, I repeat, a non-resident becomes a resident and he gets investment income from specified assets, which are debentures, deposits, securities of central government, and others. That is, the go to specified assets in 115C. This part from 2 assets from 2 to 5. This particular aspect from 2 to 5. This is not included. Shares is not included. So you get investment income from any of these, and as an NRI you become a resident, no problem. You can still avail the chapter 12A benefit. So by virtue of section 115H under chapter 12A, the NRI who becomes a resident can continue to avail rates under section 115E pertaining to investment income on debentures. The assessee must exercise this option at the time of filing his return of income along with the declaration. So therefore, even if you become a resident, you don't need to worry. You can still avail 115A 20% on investment income pertaining to debentures, security deposits, etc. So this is the, maybe from subsequent year onwards, he may again go back to his country and he'll still continue to be a non-resident. Essentially, if he, for 1 year or so, if he becomes a resident for whatsoever reasons, because NRIs, these guys would have come, say, to attend for some emergency in India, to stay back with their ailing parents, or COVID, etc. Any reason could be. So there is a small concessional continuity being given. Now, moving on to the next question, section 32, question number 32, pertaining to chapter 12A. Ms. Indra is a US citizen and a person of Indian origin. During 21 June 2021, she had invested in shares of an Indian company in convertible foreign exchange. So looks like she'll be eligible because shares there, convertible foreign exchange. She's an NRI. Subsequently, on 26 December 2021, she sold the entire shares and made a gain of INR 15 lakhs. She claims that the said short-term capital gains, because she invested on 21 June and she has sold within 4-5 months by 26 December, she made a gain. Now she says that the short-term capital gain she made from selling the shares amounts to investment income and should be taxable at concessional rate. Her interpretation is investment income from a foreign exchange asset and or long-term capital gains. This is what 115C says. That is, you derive investment income or long-term capital gains. Okay. She's saying, yes, I have a short-term capital gain, no doubt about it, but that will come under any income derived from a foreign exchange asset. So why not? Why not a short-term capital gain? So why should I not avail the benefit and make use of the concessional rate available? Because it's 20%. Imagine if it's short-term capital gain, unless if it's a 1-1A, you get 30% normally short-term capital. So maybe she felt, okay, I can take advantage of investment income and thereby get it. So question is her contention valid? Can you say this investment income pertains to short-term capital gains? One school of thought would be, no, the law very clearly specifies that you can only look at specified assets. It says investment income or long-term capital gains. So when the law clearly specifies that it is only long-term capital gains, how can one give an interpretation that, income includes capital gains under clause 24, subclause 6, 224, basically income definition includes capital gains. So, and therefore this is an income, and why not an investment income would be the logical argument from the assessee standpoint. But from a department standpoint, one would say, hey, look, we are very specific. The specific clearly says we only want to cover long-term capital gains. If our intention was to cover short-term capital gains as well, we would have mentioned it as capital gains. What is the need for us to mention that long-term capital gains? So when we mean long-term capital gains, our intention or indication that the parliament wanted to restrict the benefit of section 115E only to long-term capital gains, because the parliament wants the non-resident Indians to continue hold the shares. They don't want you to keep selling quickly and move on. What is the point then? The idea is they don't want to destabilize the market. They want you to stay here. They want you to invest, and these are assets. So they want you to have an enduring life. And the Bombay High Court agreed to this interpretation of the revenue in a case called Sham Chellaram. In Sham Chellaram's case, the Bombay High Court said, no, you cannot invoke short-term capital gains and the investment income. 115E is very specific. Parliament is very clear. Legislation clearly mentions long-term capital gains. So therefore, short-term capital gains cannot be considered as investment income. So the law very clearly specifies that it's only investment income, that is income from certain specified assets, and long-term capital gain. So short-term capital gains cannot be treated as investment income. So Chapter 12A, consequently 115E cannot be availed. Now, quickly on the last part, discuss the correctness of the following propositions. Just to wind up on whatever we've seen on Chapter 12A, a non-resident Indian having taxable income need not file a return of income under the Income Tax Act. Take you to the relevant portion. So the proposition says a non-resident Indian having a taxable income need not file a return of income under the Income Tax Act. Is this a valid proposition? So for this, we look at 115G. 115G says a non-resident Indian need not furnish a return of income under Section 131 if he satisfies the following two conditions. His total income consists only of investment income or income by way of long-term capital gains. That is, income specified under Section 115C. And tax has been deducted from such income. So tax, be it interest, be it whatever investment income he has got, interest, dividends, or capital gains, obviously Section 195 will, or 194, depending upon the specified income, that is. Normally 195. Therefore, if tax is also deducted from such income, and the income of the NRA is only investment income or income by way of long-term capital gains, then there is no need to file tax return. So this proposition mentioned in my question seems to be very broad. A non-resident need not file. This is not the case. NRI with taxable income pertaining to specifically to 115C and tax being deducted need not file return of income. This is coming under Section 115H. The other proposition, the investment income and capital gains have to be aggregated with income under other heads for tax purposes? No. If it is other income, it will be taxed at normal rates. Cannot be aggregated, cannot be aggregated. This will be separately taxable. That is 115E specifies rates for investment income and capital, long-term capital gains. Other income will be taxable at normal rates. So benefit is given only for a specific reason. That is, they want the NRIs to invest in certain specified assets in convertible foreign exchange. That is then Chapter 12A benefit can be availed. So this is broadly what Chapter 12A mechanism is for non-resident Indians who invest in certain foreign exchange assets. What are those foreign exchange assets? We saw the specified assets: shares in Indian company, public limited debentures, deposits of public limited, certain security of central government. If they are done in convertible foreign exchange, then any investment income and long-term capital gains from these assets, income from these specified assets, 115E gives a rate, And you also have an exemption available under 115F. When you sell these assets, you reinvest them and hold them for a minimum period of 3 years. So this is a very significant special treatment that is provided for non-resident Indians. On that note, there is also, I'm not going to go into the capital gains aspect because you all know this is covered as part of your normal capital gains for non-residents. Especially that under section 112, as you all know, there are no foreign currency fluctuation given and indexation benefit given for unlisted security shares. This is something which you already know. So under section 1112 and capital gains, specific for non-resident, I'm only going to touch on one aspect which may be relevant. So this is something you're all familiar with. If it's a long term, maybe just to refresh our memory. Unlisted, if it's a sale of a unlisted securities or shares of a private company, then the tax rates under section 112 will be 10% without giving effect to foreign currency fluctuation and indexation. This is mentioned in section 48. Sale of listed shares and equity mutual funds on which STT is paid at the time of sale and purchase. Then in that case, 1112A, 10% on long-term capital gains without indexation. Listed securities or zero coupon bonds, that is other than 1112A, it is 10% without indexation or 20% with indexation, whichever is lower. Section 112 specifies this. Other assets not falling into the above, you have 20% with indexation, and you have the equal short term. This is something which you already know and you're very familiar with. So I'm not telling anything new here. But what may be relevant is one aspect for NRIs. It's only for NRIs. Let's look at this. Question number 35. Mr. Sundar, a US citizen and a person of Indian origin, remits $50,000 for investing in the equity shares of an Indian startup private limited company on 10th April 2019. During 21 April 2021, Mr. Sundar sold the equity shares to Mr. Jeff, another non-resident, for the same $50,000. Determine the capital gains for Mr. Sundar. So the point what I want to drive here is not the entire capital gains, because you can see he has got for $50,000 and then he has sold them, which is a long-term capital, because 10th April 2019 is 21 April 2021. He has sold it for the same $50,000. So on the face of it, as you can see, there is no capital gains. But as you may see here, first proviso to section 48 computation gives this. That is, in case of an assessee who is a non-resident, if the non-resident, then capital gains arising from transfer of asset being shares or debentures of an Indian company, then in such scenario, what it says is, you can, if you have put it in a foreign currency, then the consideration that you would have received in INR can also be converted into foreign currency, and then find out the gain, which will be in foreign currency. That finally can be converted into Indian currency to determine. So what they're essentially trying to, this is coming under rule 115A, specifically mentions available for NRIs. Now what 115A says? So the bottom line, what the first proviso tries to do is a currency fluctuation. So if you see here, by virtue of $50,000, I'm going to say I've also got 50,000. My actual gain is nothing because my long-term capital gain is straightforward 0. But if not for the currency fluctuation reserve benefit available under Rule 115A and first proviso to Section 48. Section 48 talks about mode of computation. So first proviso to Section 48 gives the benefit to a non-resident to adjust foreign currency gains. So this way, in question number 35, by virtue of first proviso to Section 48, my capital gains will be 0. If not for the foreign currency fluctuation, I might have had to shed out a long-term capital gains on the forex fluctuations. So this is the benefit that is being given. So please watch out. If you go to Section 1112, especially 1112A, in fact 48 also says the first proviso to 48, which is foreign currency fluctuation reserve, is not available. And indexation is not available for 112A rates. Similarly, for 112, if you look for unlisted securities and shares, same effect. You will not get the indexation provision as well as the foreign currency fluctuation. I would have mentioned this in the table as well. So you are trying to opt 112 and 112A, you will not get the benefit. So please just remember it. What I'm trying to say is something which you would be very familiar with. But I wanted to bring to your notice specifically the advantage of having a foreign currency reserve. So that's why I've given a very basic example to appreciate the reason for having a foreign currency fluctuation benefit available. So in question number 35, if not for the first proviso to 48, if the first proviso section 48 was not there in the legislation, I would have had to bear forex fluctuations, whatever is the gain I'm getting, I would have had to pay long-term capital gains. But thanks to the forex fluctuation benefit, which can be availed, which can be ignored, by virtue of first proviso, I will not be paying any long-term capital gains. So this is what I wanted to bring. Incidentally, there is also a fifth proviso to Section 48. The same foreign currency fluctuation benefit is available for redemption of rupee-denominated bonds. So if you go to Section 48 Proviso 5 in your capital gains chapter, you can find out that I'm reading it for you. In case of an assessee being a non-resident, any gains arising on account of appreciation of rupee against a foreign currency at the time of redemption of rupee-denominated bonds shall be ignored for the purposes of computation. So the forex gain shall be ignored if it is a rupee-denominated bond redemption for a non-resident. So again, they are giving a benefit. They don't want you to face the forex fluctuations and pay tax on those unreal income or on the forex fluctuation gains. So therefore, these are some of the benefits that is available to a non-resident. Rupee denominated bond, you can ignore the forex gains. And similarly, look at first proviso to Section 48. Read with Rule 115A. Read with Rule 115A, which gives an option for you to, if you have brought an asset in India, bought a shares or debentures of an Indian company through in a foreign exchange, and you sell it, whatever consideration you have got it in Indian rupees, you can reconvert them into foreign exchange and then find out the capital gains, which will be in foreign currency. That will be converted into Indian rupee to pay the final tax amount. So Rule 115A talks about the mechanism, SBI TT buying rate average of TT buying and selling rate. The idea of first proviso is to give you the foreign currency fluctuation benefit. Because that is not in your control, so there's a benefit given to that effect. So this is what I would want to touch on the capital gains part. The rest of it is nothing very specific. This is very similar otherwise to section 1112 and 112A. Now, lastly, having looked at chapter 12, chapter 12A, final piece in the non-resident taxation is, are there any incomes exempt from tax under section 10? Do we have any incomes that are exempt from tax? Yes. So section 10 specifically gives benefit to non-residents from paying taxes. This is totally exempt from tax. That is chapter 3, which gives a complete exemption. There are a whole, I mean, you can look at section 10. Section 10 by itself is very exhaustive. It runs to more than 50 odd subsections, subclauses. So what specifically I would like to bring to your attention is, if you see, first, fundamental interest income to a non-resident. Now, what they have done is, I'm sure many of you will be familiar. There are incomes in the form of so in order to entice non-residents to invest in certain bonds, securities. More importantly, I'm sure many of you would know the NRE interest is exempt from tax under section 10, clause 4. This is basically because government wants the NRE who are earning money, better money due to, again, dollar, better rate. So to repatriate money into India and to entice them to bring the money into India so that India's foreign reserves will go up. So what they have done is, I'll give you an exemption. So whatever money you've earned, instead of investing in some, putting in bank deposits there, which may fetch you very little, I'll give you a good interest in NRE, and I'll also ensure that that interest income is exempt. So this way, all non-residents will invest in in NRE account, and any interest you earn from NRE account is exempt by virtue of section 10.4. These are policy driven to promote forex. It's a fiscal law, so the fiscal laws need certain incentives. Similarly, you have 10 clause 4B, where you invest in a NSE 6 or 7 issue, and then you also have for putting in a denominated bond. We already saw in 194 LC. Previously, there was a benefit also given to it, exemption, but now we have 5%. So therefore, your section 10 clause 4 covers some aspect of interest income. Now, other important is the IFSC, International Financial Services. There have been some exemptions in the recent past. International Financial Center, as you may know, is India's first international financial center set up in Gujarat. Basically, that will be like the London International Financial Center or Dubai International Financial Center. The idea is all financial related activities will happen that's like it's a special economic zone. The idea is there will be a stock exchange, but everything will be done in a non-rupee. So everything will be done in foreign currencies. Now the government has been promoting a lot of foreign banks to set up, or foreign insurance companies, investment unit, aircraft leasing units. So in order to promote IFSC, so they're asking all non-residents, instead of having a fund in Mauritius, come have a fund in Gujarat. So that IFSC is almost like even though it is in India, it is a foreign unit. It is like as if you're doing business in a special economic zone. It is for FEMA purposes, foreign exchange purposes, it is treated as a outside India jurisdiction. So everything will happen in a foreign currency reserve. India wants to set up a strong financial center. So that way, a lot of Indian talent, which is working in all the big financial institutions, especially chartered accountants also, they want them, instead of going to London, Hong Kong, Dubai, they want them to work in the Gujarat. So in Gujarat International Financial Center. So GIFT you can have the idea of this exemption is in order to promote these non-residents to come and invest in IFSC units to do certain businesses, that is financial product related businesses. There are exemptions given under 10 clause 4D, 4E, 4F, specifically deals with IFSC. These are new phenomena. The idea is to incentivize. That's why you also have a similar deduction available for IFSC units under section 80L, which gives you benefit for units. Similar to a 10AA, you also get deduction, tax holiday deduction for IFSC units. And for investors in IFSC units who are predominantly non-residents, any income that you get from these IFSCs, they are trying to give exemption under 10 clause 4D, 4E, 4F. Now, another very important exemption that you should be aware about is short stay exemption, that is under section 10 clause 6 subclause 6. Now, why is this very relevant? If you see question number 36, with a lot of foreign employees coming to India for short-term visits, so basically this is called a short stay exemption. Now, what does it say? Let's take question number 36. Mr. Peter, an Australian citizen, an employee of Kangaroo Private Limited in Australia, visits India. He's an engineer. As part of the agreement between his employer, Kangaroo, with Mrs. BNSL Limited, an Indian company, he visits India to provide training to all the employees of BNSL. He visits all the branch offices and stays in India for around 80 days. So in this regard, whether Peter's remuneration will be liable to tax in India. You remember section 9, clause 1, subclause 2, team to acquire India for salary earned in India. So will this be an income to the non-residents? Will it be a deeming income because the salary pertains to his stay in India? So can the salary that he receives in Australia is because of salary earned in India? Therefore, should he be liable to tax? So to avoid that issue under section 9, clause 1, subclause 2, that is deemed to acquire in India for salary earned in India, there is a short stay exemption provided. That is what section 10 section 10 clause 6 subclause 6 says is 10.6.6 says is if you stay for a period less than 90 days and that foreign company is not engaged in any business, that is the Kangaroo does not have a separate office or something, and nobody else take these expenses. Basically, they're trying to say you don't have a branch office, etc. So in that case, you can avail a short stay exemption under section 10.6.6. So this is available if these three conditions are satisfied. That is, the foreign enterprise is not engaged in any business or trade. The employee's stay does not exceed 90 days. And the employee's remuneration is not liable to be deducted from the income of the employer chargeable under the Indian Income Tax Act. So when will you deduct? Only if you have an operations in India, you will try to deduct. Otherwise, this will not be deducted under the Indian Income Tax Act. This will only be deducted under the foreign companies, local legislation. So if all these three conditions are satisfied, then you can take a short stay exemption. That is, this income will not be, Peter's remuneration will not be taxable. If he stays for more than 90 days, there is a problem. So then you may lose the short stay exemption. So you need to be aware about the short stay exemption that is available. Similarly, there are a lot of interest exemption that is given on bonds, deposits, foreign currency deposits the government brings in. This is basically to ensure that, again, similar to how we saw NRA account, they're also come out with NRA bonds, NRA deposits, and then any loan foreign currency deposits under section 66, which is, for our NROs. It's a specific based exemption that is available. I'm just giving you a broad indication. And then finally, I would want to say there's another very interesting exemption which is relevant is section 10, clause 50. So what it says is, if a non-resident is levied tax under the equalization levy, we'll discuss equalization separately in the last session. If a non-resident is chargeable to equalization levy, then he is exempt from tax under the Income Tax Act. Now, what is equalization levy? Why is it relevant? We'll have a look at it, but you need just to keep in mind, park it somewhere in your mind. We'll discuss this in later. If a non-resident, so which all obviously now very clear that equalization levy is applicable only for non-residents. So if a non-resident is levied equalization levy, then he need not pay tax under Income Tax Act. So what is equalization levy? Does it not come under the Income Tax Act? For what services he will to pay? How much he has to pay? All those implications we'll discuss in detail. So broadly, these are the incomes that is exempt from tax. At your level, from an exam standpoint, I would specifically want you to look at 10, 4D, 4E, 4S on the IFSC, because those are the recent amendments made. So if at all examiner wants to test, he may probably throw something on the IFSC related. So please look at 10, 4D, 4E and 4F on IFSC part. Otherwise, the rest are all traditional incomes that are exempt from tax. So with this, we are done with taxation of non-residents. So we started off, going back to the scope, the first, when we started, so we looked at POEM, we looked at the deeming provisions under section 9. We just looked at what are the incomes that are exempt from tax. Presumptive taxation, specifically, we looked at 44DA, 44DPP today. And then from a non-resident standpoint, income under special cases, that is 115 BBA, sportsperson, foreign institutional investors, we focused on. And then chapter 12A, incomes for non-resident Indians, that is investment income and long-term capital gains at a concessional rate, exemption available on those specified foreign assets, we covered under chapter 12A. Withholding tax, 195. We also looked at other nuances on 196D and 194E. So basically all those incomes that is available will, by a resident, has to withhold taxes. Agent of NR, you would have covered in a separate chapter 163. And there are some other miscellaneous aspects. It is there in the material, which in my view are not very relevant. For example, a license office has to submit a statement and other aspects. You can go through the material just to be cognizant about those small miscellaneous provisions. This we will do it separately in the next session. So with this, we have broadly covered the very relevant aspect of taxing non-residents. In the next session, we will look at double taxation relief, that is tax treaty, because having looked at domestic taxation, the next thing is we have to look if there's any benefit available under the tax treaty law. And what is tax treaty law? Why do we need? We will have a look at it. And then we'll finish it off with equalization levy and also the dispute resolution mechanism of the AR. So with this, we will have a strong overview on how a non-resident will be taxed in India. So with this, I'll stop today. And if there's any questions, I will answer them. Please also go through all the relevant problems that I have shared, almost 30 odd. Debenture not specified assets, so not claim exemption. Okay. If NM, okay. As Mr. Ray is resident in FY22, so we can't claim. Okay, I have answered that, Namita, for question 31. So then 2 point. Second point of section 115F into 115. Yes. Short-term capital gain is also taxable. I don't know, not able to understand your question, Namita. So basically, 115F is giving an exemption. And if you're able to claim exemption under 115F, which is basically you selling a long-term specified capital asset and then reinvesting within 6 months in that specified capital asset, we retain it for 3 years, you get exemption benefit. What are conditions for availing exemption? NRI account as joint holders. NRI can have a joint holder, but that's okay. But the main holder will be the non-resident. The joint holder will be for a joint account convenience purposes for operation. But the main account will always be only if you are a non-resident, you can have an NRE. If you come back to stay in India, then you need to close your NRE account and then open your normal savings account. And similarly, if you are going outside India, close your savings account and open an NRE account. So this is the regulation. So come back to India, then and if NREs are joint holders, anyway, interest income is exempt from tax. So it's an either or basis or survival basis, depending upon. Anyway, taxation is not an issue. Okay, I don't see any further questions. So, all right. Thank you very much, then. Please have a look at whatever we've discussed on non-resident taxation. So we will continue with double tax relief on Wednesday. So until then, thank you very much and good night to you.